What do you make of this? Does this fit with what you'd expect Christian Sewing to deliver?
Yes, I think this is the first step in a broader restructuring story. We've obviously heard in recent weeks a number of press reports suggesting we could look at a balance sheet reduction of something in the order of 50 billion, and I'm sure this is part of that broader story. And when we've got to think about how do you move the needle here? This is a bank where consensus in 2021 thinks Deutsche Bank will earn approximately a 4% return on equity. So we've really got to move that very substantially. As you say, the final roll of the dice, you've got to get this number, you've got to double that number to be credible in the eyes of the market. Certainly, small moves announced today, half of the equities business going, that's a step in the right direction. Let's try and quantify that. We don't get great disclosure from Deutsche Bank, business by business, but analyst estimates out in the street suggest that the equities business has been losing something in the order of 400 to 600 odd million. So if we assume that they can either cut half of that or all of that loss, then that would be accretive to the ROE of 50 to 100 basis points. So we've now got from 4 to 4.5, maybe 5. But there's still a long journey ahead. And I think that's the key issue here is marginal moves in the equity business are helpful, particularly for a stock trading at 0.25, or as your colleague Stephen just mentioned, record lows. That's certainly incrementally helpful. But to really move the dial here, we have to start making big inroads into the balance sheet and to substantial cost cuts into the external cost base. And to do that, unfortunately, Deutsche will be treading a very fine line on capital because big cost cuts in Germany and around the world incur substantial costs to achieve, restructuring costs. And that's the challenge we have here. Restructuring costs and costs attached to asset sales and asset reductions will place significant pressure on the capital until such times as the benefits of those asset reductions begin to give a positive kicker to capital. Of course, the cuts coming right now in the equity business will lead to a revenue decline before the costs actually fully come out.
If Deutsche wants to compete with big US banks, and it goes down the route of a kind of more of a focus on the CIB and more of a focus on the C than the IB, how does it make sure that as it cuts the IB, it doesn't hurt the C?
I think that's a great question. I mean, you can cut half of your equities business, and as you said, it begs the question whether the global ambition, therefore, has been lost. And when you lose your global ambition, you fall out of the top-tier bracket, and there become revenue consequences attached to that. So that is a big challenge. Now, focusing on the C is another problem in a low-rate world. And possibly a lower rate world. Corporate margins are only going one way at the moment, and every conversation I've had with CFOs and CEOs in recent weeks certainly suggests that the next leg down in rates in Europe is going to be a further headwind, both to effectively the deposit yield effect and also the corporate profit margin, the loan margins. And it's something that's just unavoidable. And bear in mind, Deutsche Bank is the most rate-sensitive bank in Europe, in large part because of the starting weak profitability. But to put a sense around that, we talk about the equity cut and the potential benefits if they were to remove the losses attached to that business. But Deutsche Bank, in its own annual report, discloses its rate sensitivity, and it says 100 basis points parallel shift upwards gives them a kicker of about 1.8 billion in revenues. Now, they indicate that on 100 basis points reduction in yield, it's only a 400 million reduction. Now, if we assume that that may be an optimistic 400, we've more than offset the benefit from the equities. So this is a really challenging time.
Just a quick question on the stress test. Were you a little surprised to see the pass?
But pleasantly surprised. So the stress test drawdown is still pretty significant. But yes, I mean, the Deutsche Bank has clearly, and we've talked in the past, the efforts made ever since John Cryan came in. They've made an enormous effort in restructuring on the compliance, on the capital planning, on the risk management front. So, kudos at least to the management. They have addressed and dealt with something that was in their gift, within their control. Interest rates, of course, is not, and that's something that's going to continue to hurt them.